Taxation is a fundamental component of every economic system and provides governments with the revenue necessary to finance public services, infrastructure, healthcare, education, and other public expenditures. Taxes may be levied on individuals, businesses, property, transactions, or consumption. Among the most significant forms of direct taxation are corporate taxes and personal taxes. Although both are imposed on income, they apply to different taxpayers and operate under distinct rules and objectives. Understanding the characteristics of corporate and personal taxes is important for management accountants because taxation affects financial performance, investment decisions, cash flow management, and overall economic behavior. Corporate tax is a direct tax imposed on the taxable profits generated by companies and other incorporated entities. Taxable profit is generally derived from accounting profit after making adjustments required by tax legislation. These adjustments may include adding back non-deductible expenses, deducting allowable expenses, and applying specific tax reliefs or incentives. Corporate taxation ensures that businesses contribute to public finances in proportion to their economic activities and profitability. The amount payable depends on the applicable corporate tax rate and the taxable profit calculated under the relevant tax rules. Corporate taxes therefore represent a significant cost and planning consideration for organizations. One of the key features of corporate taxation is that it is levied on a separate legal entity rather than on the owners of the business. A company is treated as an independent taxpayer, distinct from its shareholders. This separation means that profits earned by the company are taxed at the corporate level before any distributions are made to shareholders. Governments often use corporate tax systems to encourage investment, innovation, research and development, and economic growth through the use of tax allowances, exemptions, and incentives. Consequently, corporate taxation influences strategic decisions regarding financing, investment, expansion, and international operations. Personal tax, by contrast, is imposed directly on the income earned by individuals. Sources of taxable income may include employment earnings, business profits, investment income, pensions, rental income, and other forms of personal revenue. Personal taxation is generally designed to reflect an individual's ability to pay and often incorporates allowances, deductions, and exemptions to reduce the tax burden on lower-income taxpayers. Governments use personal taxation not only to raise revenue but also to achieve social and economic objectives such as income redistribution, poverty reduction, and the promotion of economic fairness within society. A distinguishing characteristic of personal taxation is its frequent use of progressive tax rates. Under a progressive system, higher levels of income are taxed at higher rates, meaning that individuals with greater earning capacity contribute a larger proportion of their income in tax. Personal tax systems may also provide reliefs for dependents, education expenses, retirement savings, charitable donations, and other socially desirable activities. Because personal taxes directly affect disposable income, they can influence labor supply, consumption patterns, savings decisions, and investment behavior. Consequently, governments must balance revenue generation with economic and social considerations. In summary, corporate and personal taxes are important forms of direct taxation that apply to different taxpayers and serve distinct purposes within the tax system. Corporate taxes are levied on the profits of companies and influence business strategy, investment, and financial performance. Personal taxes are imposed on individual income and often support broader social and redistributive objectives through progressive tax structures. While both contribute significantly to government revenues, their design reflects the differing characteristics of businesses and individuals. Understanding these features enables management accountants and financial professionals to assess tax implications, support compliance, and contribute to effective financial planning and decision-making.